Hello all, this is David Rodriguez, quantitative strategist for dailyeffects.com, here to talk about what we're looking for in the dollar in the week ahead. So it's basically a continuation of what we were talking about last week. The dollar's in a fairly pronounced downtrend right now, but the key question is, how do we trade it? So let's take a quick look at a chart just to get a sense of, realistically, our strategy in the days ahead. So like I said, on a year-to-date basis, this is a chart of the Dow Jones FXCM Dollar Index. On a year-to-date basis, we're in a fairly pronounced downtrend. But, and it's a major caveat, we're coming up on fairly significant support here. In fact, as I speak, the dollar is testing year-to-date lows and what is fairly obviously the 618 Fibonacci retracement of the multi-month advance here. So this is pretty much a make or break level. At the same time, we're seeing a sharp drop in volatility expectations that's not new. Volatility prices are trading near their lowest levels since the onset of the financial crisis back in 2007, which, all else remaining equal, favors fairly slow price moves in the weeks and months ahead. So realistically, what are we talking about here? Well, on the one hand, if you're trying to range trade, this is probably not a bad time to buy the dollar dip. Realistically, if you're playing into the broader trend, you wait for the dollar to bounce and then sell into that. So for example, on the euro dollar, key short-term support is seen around 38.70. You might buy that against, for another run at the high. I wouldn't buy at the high of the euro dollar. Volatility is just too low. There isn't enough impetus. You would basically be selling the dollar at support. So take a look at the full article below for further clarity. Best of luck trading, and I'll talk to you soon.